Stay at the forefront of trends, research, and topics that impact your well-being with our monthly Hot Topics podcast. During our 12 minutes together, we'll jump into the minds of our expert coaches and give you tools to lead a healthier, more vibrant life.
In these tumultuous times, there's a lot to consider. One of the most important, and honestly, kind of the most stressful unknowns that we're facing on our own is our bank accounts and also our investments. So rather than panic, it's important to focus on the things that we can control and prepare by being informed. Hi, I'm Molly Proct. I'm Aduro's Human Performance coach, trainer, and mentor, and welcome to Hot Topics. Joining us today is Adam Costarella, financial advisor and managing partner at Calibri Capital. Calibri is a financial advisory practice of Ameriprise Financial Services. Welcome, Adam. We are so glad that you're with us today as we navigate these uncharted waters.
Thank you. Thank you for having us or having me, and I'm thrilled to be joining today. I think this is a fantastic service that Aduro is offering, so I appreciate you guys having me on as a guest.
Absolutely. I know our audience is equally excited as we're eagerly kind of looking forward to experts in this world. So let's start with just the obvious, the validity of the market. What is your perspective with the short and the long-term impacts here?
Yeah, very good question. So I guess I'll start with some bigger picture views, sort of what we call macro economic thoughts. I always like to, just to make sure people understand some of the topics that are being thrown around. Volatility itself is something that can be confusing, but is a term used frequently. In this case, what people mean when they say volatility is the wide swings in the stock market. We've seen days where we're up 10% in one day, and the days where we're down 10% in one day, which is abnormal for a normal situation. So that's just a quick take on the volatility. One thing I like to start with, and this is a conversation I've had very frequently, is that volatility, sort of the wide swings in the market, were expected this year. Before we knew what was going on with the virus and COVID-19, we did expect volatility because we were at all-time market highs coming into beginning of 2020. That led us to believe that we're going to have some volatility this year. That coupled with it's an election year, and we generally have market volatility in election years. Another thing that I think is super important to remember, when people say the markets, they generally mean the S&P 500, right? Just so people know, those are the 500 largest companies in the U.S. And unless you're using what's called an index fund, your specific portfolio is not the S&P 500. So even if the markets go up 10% or go down 10%, that does not mean that your 401k, your IRA, your investment account is swinging wildly with the market. So I think it's always important to keep a little perspective, comparing your portfolio to the actual markets.
Okay.
Another thing that I think is sort of important to keep in mind is that the markets are not taking into account your personal time horizons. And so what that means is large institutional investors like all the banks that we've heard of, they're selling and buying investments on a shorter term basis than most of us are investing our money on. Right? Most of us are planning for retirement or longer term investment horizons. And so just because something is selling off in the overall markets, just because stock is down, just because mutual funds are down, does not necessarily mean that we need to take action based off of that. Markets are, as we've seen, they can be very irrational. And so sometimes they trade based off of investor sentiment, right? How people are feeling about the prospects of the stock market rather than actual economic data. So those are some high level points that I always like to remind people, because you get caught up in the headlines and you're always just tracking the S&P 500 on your stocks app on your phone, it can be sort of discouraging at times. So I always like to keep positive with those thoughts.
Thank you. And that is a pretty large breath of fresh air just for those that are kind of watching that or just hearing the buzz around, the market's going to drop. That means the economy is going to drop. And it can be overwhelming when you're a little bit unsure or uncertain of how that all works. So thank you for that kind of explanation.
Of course. Yeah. So I break down the government's response to the most recent stimulus package that probably everybody's read about, and I'll talk a little bit about that. The Federal Reserve, so that's basically the central bank in the United States, essentially a government bank. They've taken a couple steps that people have also probably read about, but they've lowered interest rates to all-time lows, and interest rates are basically the cost of borrowing money. So what that means is, you and me, if we need to go out and get a loan, the rate that we pay theoretically should be lower than it was a year ago or it was 2 years ago. That should help people with spending, and that should help people with the cost of borrowing money from banks and institutions. The most recent stimulus plan, it breaks down to a couple key points, in my opinion. Probably the hottest topic right now, the direct cash payments,
Yes.
recovery rebate as they're being called. So
Mm-hmm.
essentially what the bill actually says is that based off of adjusted gross income, so basically based off of your gross income minus some payments that you've made, 401k contributions, IRAs, things like that. So based off your adjusted gross income, individuals should receive up to $1,200 per person, and then $500 for each child. As of now, it sounds like this is going to be done relatively quickly, within the next couple of weeks is what the government is saying. And if the IRS has your bank account on file because you've paid taxes from it before, or gotten rebates from it before, they're hoping to just basically plop the money back into your account.
Okay.
They're trying to make it as simple as possible, and they're working to get money sort of back into the hands of people as soon as possible through those direct cash payments. There are a couple other things that impact us as individuals. There's basically a provision that allows for people to access their retirement plan dollars. So think 401ks and IRAs without being hit with a normal 10% IRS penalty. So a year ago, if you or I, under the age of 59, someone else under the age of 59 and a half were to take money out of a 401k or an IRA, we'd end up paying a penalty, a 10% penalty to the IRS and ordinary income tax. Well, this stimulus plan basically waives that 10% penalty and allows you to pay the income tax over the course of 3 years. So another sort of nice benefit for individuals. This is obviously something if people are in dire straits and need cash quickly, the only money that they have is in their 401k. Well, obviously this is designed to allow people to access that money relatively quickly.
And to clarify, so what you're saying is the penalty that you or I would typically pay up front, we would then pay that back over a few years. Is that correct?
Yeah, good
Okay.
point. So the penalty, the 10% penalty is actually waived as of now. So you don't have to pay the penalty. You'll still pay ordinary income tax just like you would any other time.
Okay, got it.
You can pay the income tax over the course of 3 years. You can also basically roll that money back into your 401k or IRA within 3 years and end up not paying anything sort of out of pocket to access those funds. So this is a big expansion of some of the personal changes that we're allowed to make to access our retirement funds as individuals.
Got it. And you mentioned, and I think this might be valuable, like from your kind of expert perspective, this would be done. You would recommend this being done only if absolutely necessary, correct?
100%.
Yeah.
Yep. I rarely recommend people access their retirement savings prior to retirement. You're sort of robbing from your future self. But if it's, if it's medical bills, paying mortgages, paying, expenses that you need to pay, obviously this is accessible. But yes, obviously would not recommend accessing it if all possible.
Got it.
And then the last thing that I think is important for a lot of individuals in this country is that student loan payments have been suspended. So basically the new bill allows individuals to defer payments on federal student loans through September, basically end of September of this year. And then if some people have Pell Grants, those can be kept if your school has been canceled because of this. So student loans, I know, is another hot topic, and this addresses that as well.
Kind of circling back to, the previous piece of accessing, do I access my investments right now and kind of get this 10% penalty waived? That kind of goes into a submitted question that may be on the same vein. And so for those of our listeners that may be really close to retirement, maybe 10 years or so, they're worried, right? And so is there something that they can do to have this be a little bit less impactful, given kind of the retiring in a short-term time frame that doesn't include accessing or tapping into their retirement funds early?
Yeah, great question. So, part of the thinking that I read that I have is that, even if we head into a recessionary period where there's an economic slowdown in this country, we expect there to be a relatively quick recovery. One of the extremely important things that the government is doing right now is acting quickly and big. They're acting very large with these stimulus package and what the Federal Reserve is doing. And so, if you have a 10-year time horizon, we fully expect to, be well back into, a strong economy and strong stock markets, and ultimately have your portfolio bounce back. For the shorter time frames, if you're, retiring this year, if you're retiring, in a couple of years, the name of the game really is how to position your portfolio to reduce some of the downside of the markets, so you don't keep losing money. But ultimately, the goal is to position your 401k, your IRA, into income producing investments like bonds or dividend paying stocks, things that will produce income rather than sort of fluctuate wildly. That's really my general recommendation for people as they approach retirement is you got to shift your portfolio from growth to income primarily, and hopefully that's already sort of been in the works for people in that 10-year out from retirement time frame as they're approaching retirement, so they probably have not felt the full brunt of this market, which is a good thing.
Speaking on kind of a different perspective too, somebody that may have a little bit longer, a longer time to sit on our investments, maybe not approaching retirement in the next 20 years or so. I know that I of course, I took a peek at my own 401k and was a little concerned
Yep.
given everything that's happening. So I know a lot of people out there have also kind of looked at those certain funds that they have through their employer or whatnot. And so for, given the drop in the 401k, and yes, you mentioned kind of a quick recovery, is it a good time to convert anything into a Roth IRA from a 401k, or is there any other type of area that I should be moving my money into for this time period that may be a little bit better than others?
Yeah, very good question. So on the 401k conversion to a Roth concept, just for people who are a little bit less familiar, traditional 401ks are what we call pre-tax dollars. So you put that money into the account before you pay tax on it. A Roth works exactly the opposite, where you put that money in after you pay tax. And so you have the ability to convert it from pre-tax to after-tax dollars. Now, to me, that's a function of your overall household income. If you're at a certain level and if you make an extra dollar, if you're bumped into the next level of income tax, then it may or may not make sense, because when you convert money from pre-tax to after-tax through a Roth conversion, whatever the amount is that you convert will be tacked onto your ordinary income tax. That could not mean anything if you're sort of at the lower end of your tax bracket, or it could bump you up into a higher end. So when we're looking at something like that, I always recommend people to sit down with their tax advisor, their financial planner, and make sure that what they're doing is going to make sense given sort of everything in the markets. But that question is really dependent less on the performance of the accounts recently and more on your personal income tax situation. And remind me your the second part.
Yeah, just thinking about like the different options, whether it's 401k or a Roth, or is there, when you think about, any other types of funds that moving money into for this period of time would be beneficial?
Yeah, most 401ks have sort of a broad range of investments, and most IRAs, same thing, where you have, on the most conservative side, you'll have something like a money market fund. Money market funds are close to cash alternatives as you can get, and so they are going to be less volatile. They're not going to move up and down in the stock market. On the other end of the spectrum, you're going to have mostly index funds that are based primarily on the stock market and will be the most volatile. Based off of people's time horizons, if you've got, 20, 30 years, what I've been telling people is, look, we expected to have a couple recessions in that time frame, right? Generally, we see these market swings every decade or so. And so, the last thing that I recommend is any rash changes to a portfolio. I recommend sort of keeping a cool head, checking your 401k, being aware of where it is, but trying to resist making broad sweeping changes to a portfolio, as long as you're originally invested in the allocation you wanted. And so right now, currently, what we're seeing is that any market downturn, we expect to see, a relatively quick recovery. And so I normally I don't advise broad sort of rash changes in anyone's portfolio.
Got it. Thank you for that. And I think it's kind of nice to recognize like the expected regressions per se over the next 20, 30 years are expected, right? And this is kind of like a normal fluctuation of our economy. Maybe not to this degree or this severity, but
Yeah.
just kind of noticing that I think allows people to kind of breathe a little bit easier. When you think about the different options that people may have to kind of invest in, like for example, thinking about adding voluntary insurance, like extra long life coverage, from a financial perspective, what would you recommend kind of tapping into any of those additional coverages right now?
Yeah, that's a very good question, and I think the benefits like voluntary life insurance or long-term disability hold up regardless of what the markets are doing. Generally, I tell my clients that we want to see enough life insurance to cover all of your debts and liabilities, so mortgages, credit cards, student loans, things that you owe money on, plus a couple of years of replacement income. Obviously, the situation we're in, this is obviously a health scare, and so if people are worried about the actual health that they're going through and those kind of things, then yeah, I'd say looking at additional life insurance coverage can make a lot of sense. Adding some long-term disability insurance, which is a different type of coverage, can also prove to be beneficial if something happens to someone's employment situation. But in general, I definitely do recommend carrying enough life insurance or long-term disability insurance for your needs. And a lot of times that means looking at a voluntary policy that's offered through your company.
Got it. Thank you. And kind of noticing that might not be a necessary option given the current situation, but just in general.
Yep, exactly.
Yeah. When you think about someone's kind of personal financial plan, right? And we're hearing a lot of buzz about if you have the money invested into, not invest it, but give back to the economy, continue to support small business, continue to spend money, with people that want to do their part in sustaining the economy right now, but also kind of a little bit reserved in that regard because we don't really know how long or the continued impact this will have. What would be maybe your top 3 best practices right now for someone in their overall kind of their financial well-being?
Yeah, I can speak sort of just based off of my own experience and what I'm doing. When I drive around my town, I see that there are a lot of small businesses closed. And so I think it's extremely important to continue to support small businesses in your area because they're the companies that don't have the excess cash reserves like some of these big corporate employers do. They're the ones that are going to be hurt by people staying at home. And so I think supporting the local restaurants, the local businesses, buying gift cards, things like that is extremely important. I also think it's very important to take a look at your overall financial situation, figure out how much debt you have, how much it's going to cost to basically pay the service on the debt, to pay the interest on the debt, and make sure you have enough liquidity sort of in quick access accounts like checking and savings accounts prior to making any long-term investments, right? Because right now we're in an unknown situation, so we don't theoretically know how long this is going to last. And so I highly recommend maintaining as much liquidity as you feel comfortable having. And then I always recommend sort of keeping a calm head with the markets and with the economy. I know if you sit and read news and all the grim news that's out there, it can get overwhelming. And so I always recommend people to take a step back and look at their own personal situation and make sure that they're acting in their own best interest rather than what they're seeing on the news or in newspapers.
Thank you. And I'm sure you probably would recommend if anybody has any, resources or has connected with a financial advisor or planner of whatever kind, now is a great time to reestablish that relationship and just kind of get a personal look into their, their financial plan or their financial well-being for sure.
Yeah, without a doubt. I recommend using the professionals in your lives and the experts in
Yes.
your lives it's extremely important at this time.
Yes. Adam, thank you so much for being here today and answering our questions and just kind of reducing this overall uncertainty around this area of life, one that's really, really big on people's minds because of the long-term impacts. And just to kind of wrap it up, the 3 takeaways that I hear, that I hope our listeners are hearing as well, is that the markets will recover. And we're hoping and we're looking and forecasting a quite quick recovery at that. The government is acting quickly to kind of slow down the downturn and quicken that recovery. And also, overall to focus on your personal financial plan and work with the experts, work with the investors and the resources that you have as much as possible. So thank you very, very much, Adam.
Of course, thank you for having me.
Thank you, everyone, and we hope you're well.
We'd love to hear from you. What kinds of lifestyle and well-being topics are on your radar? Do you have any questions for our experts? Drop us an email at hottopics@adurolife.com. And if you found this Hot Topics conversation helpful, share it with your colleagues. Thanks for joining us for this conversation. Until next month, be well and find your fire.